This morning, historically, the stock market can behave strangely in the months and weeks leading into an election. Local financial professional Tom Neumann from Drake & Associates is here to explain how elections can affect Wall Street and what investors should keep in mind as the presidential election draws closer. Tom, good morning.
Good morning to you, Mike. How are you?
Very good, thank you. So in what ways does the market behave differently during election years?
Well, historically, there's been a lot of volatility that has happened during the election years. A lot of that has to do with, people bringing their emotions into their investing decisions, which can often lead to bad outcomes. In all reality, though, historically speaking, both the stock market and the bond market, for that matter, have had returns during election years that are comparable to non-election years. So when you take a broader view and a longer view, there's not much difference, but throughout the entire year during an election year, a lot more moves both up and down.
Are investors just guessing or hoping based on policy plans for the candidates?
You got it. Oftentimes throughout an election year, polls come out, right? And those polls will show that maybe one political party or one individual is leading and is more likely to be elected. Therefore, if you are connected to that political party, you feel confident and may start to buy into the market a little bit more. Contrarily, if you are on the other side of that equation, maybe you feel nervous, you're fearful, you start selling out of your investments because you don't like maybe the direction of where we might be headed.
Well, it sounds like many investors should just be kind of sitting tight because it's all going to bounce right back or back down, I guess.
Yeah, in all reality, when it comes to investing, whether it's in the stock market, the bond market, you really should take a long-term view. Risk is really important to assess and to sit down and understand how much risk you're taking. But when you're trying to time the market, usually it's a bad outcome because there can be a lot of volatility throughout any given year. But if your goals are more than, say, 10 years out, you're supposed to be on this long-term track. And like I mentioned earlier, historically speaking, the markets tend to go up if given enough time for your money.
However, if you are less than 10 years out, if you're 1 or 2 years from retiring, or if you're going to retire next summer, for example, you're worried about what's going to happen.
Absolutely, because you've spent your entire life building up your nest egg, and you just don't want to be on the precipice of retiring and then see a huge dip down. That's why it is really important to sit down with a financial advisor, financial planner that can really help you analyze your risk and make sure that you are well diversified, that you're allocated appropriately given your age and the stage of life that you are at or will be entering soon. That's really, really important. We too have a lot of resources at our website, which is drakeandassociates.net, if you need some help in this area.
All right, that's a great place to start. Tom, thank you so much.
My pleasure. Have a great day.
You too.